In this video clip, we introduce how to simulate correlations between different random variables using @risk. Here are some background. So we use this example. Here we have an initial investment, 500,000. Then for year 1, we have return randomly generated from a triangular distribution with low, mean, and high. The mean actually is the mode for the triangular distribution. And also we have the next year, the third year, and so on. And we assume a 10% discount rate. Then using the discount rate and the cash flow, we can compute the NPV for the cash flow, and the net return will be the NPV minus the initial investment. Then here we have a risk output, so we can simulate the output here. Here, each year's return follows the given triangular distribution. So here we click Simulate. We obtain the following distribution of the net return. Here we can note the mean is close to $29,000. The standard deviation is close to $32,000. We can close this as of now. In reality, there can be correlations between different years' returns as in this column. So here we can use a correlation matrix to model the correlation. We select this column and click correlation. And here the input is A4 to A10. Then click OK. Here we can specify the correlation coefficient. For adjacent years, let's use 0.8, 0.8, adjacent years. And for years 2 years away from each other, we use 0.5. The matrix is symmetric. For all others, we leave them as 0. Note that the correlation matrix needs to be consistent because the correlation is transitive. So here we need to check matrix consistency. Click OK to adjust to be consistent. Okay, so we can see the numbers are changed a little bit, but let's use these numbers in the matrix. We can see the correlation. So basically, for adjacent years, we have a fairly strong positive correlation, then weaker in when the years are 2 years from each other, and they are even weaker as the years go far away from each other. Okay, so we can click OK. So then we need to specify a location. Let's use A17. Here we go. So here we have matrix. So we can see here for the simulation of the return, it incorporates the correlation matrix for all the input in the column. Okay, now we simulate again for the net return. Simulate. Here we go. So we can see for the mean is very similar, still close to $29,000. However, the standard deviation becomes much larger. Here is close to 52,000. This is because due to correlation, when the first year's return is bigger, the following year is also likely to be bigger. On the other hand, if the first year is smaller, the following years are also likely to be smaller for return. This enlarges the standard deviation or the variance.